Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. That show should give you a sense of what we're talking about. Everything related to your money matters. And today I'd like to speak about investing in global equities. Now, if you've been following the show, or if you're reasonably familiar with the landscape here in India, then you know that it's getting harder and harder for Indian investors to deploy money overseas. And that's because the Reserve Bank of India, and by extension the Securities and Exchange Board of India, has not increased the overall threshold for Indian mutual funds to invest in global equity. But there are a few options that are opening up. Among them, the DSP Global Equity Fund, which is going to be operating technically not in Indian shores, but in Gift City. And that, if you can think about it, like an island that is operating in India, that is separate from India, but actually allows you access to the global markets, then that's how you should think about it. Join me to talk about what this fund is all about, why it's different from everything out there, and whether it's an opportunity for you to consider. I'm joined by Vijay Mantri, who is an investment expert, as you know. Vijay, thanks as always for taking the time.
My pleasure.
So first, before we get into DSP and this new offering that it has, I described the Gift City in a certain way. I described it as an island that gives you access to the globe. Is that the right way to explain it?
I think this is fantastic. This is the crux of forget about the legality, but this is what it is. It is a window through which you invest in international market. It is a window through which international investor can also come in. So it's like a global financial center. It is at the initial stage, but I think over a period of time, the intent is to make it as competitive as Singapore or Dubai.
So, and to complete this point, from the lens of an Indian investor, and here I'm only talking about a retail investor looking to invest abroad, if they're going through GIFT, then effectively they would have to go through the liberalized remittance scheme route, which allows you to put $250,000 in assets abroad, take that much money out every year, correct?
That's right. Per PAN card, you can remit up to 250,000 USD. That translate into, at current exchange rate, around 2 crore rupees. Approximately 2 crore is the number per PAN card.
And that's the way that you invest through GIFT.
So this is the way you will invest in groups. So if I'm an Indian investor and I'm looking at international exposure, the easiest route earlier available to me was invest through fund of fund, which mutual fund offer.
Yes.
But there's $7 billion limit, which already we busted, and RBI is not allowing incremental money. And that is the reason you see all these funds have a difference between NAV and the price. Okay. Now, the Gift City routes was opened up. So you could invest through Gift City, but it is only through LRS route. Now, the challenges with LRS route and Gift City is that the minimum investing amount is 150,000 USD. So that is around, the starting amount is 1 crore only. So it is away from many investors. And second problem is that in LRS, suppose your remittance is more than 10 lakh rupees, then there's a tax collection at source, which is 20%. Definitely you can take that claim in your income tax against advance tax and in your other things, but at least your cash flow get blocked for time.
20%, that's a lot.
Beyond 10 lakh rupees. Yeah. So if you are investing in Gift City fund, normal Gift City fund, then suppose your investing amount is 100,000 USD, that is 86 lakh rupees. So beyond 10 lakh rupees, 20% you have to put. Okay.
And that's earning you nothing.
That's earning you nothing, but see, you have advanced tax, you can use the
You can set it off.
You set it off.
You can set it off. If you're operating at that level, perhaps you have that kind of stuff that you can do. But having said that, that brings us to this conversation, which is the DSP Global Equity Fund. And it is aimed at your retail investor because the ticket size is much lower. The minimum amount that you have to put in is $5,000. Is this the game changer that people are talking about?
I think this is a game changer because 5,000 USD means 4,30,000 to 4,50,000, depend on the exchange rate on that particular day. So it has come within the reach of middle classes. And suppose you have 4 members in the family, effectively you can do 20 to 25 lakh rupees annual. And you can go up to 10 lakh rupees without incurring TCS. So that way it is a game changer. And I also, hearing that the amount is going to go down further and further.
Okay.
Starting 5,000, perhaps they will make it 500 USD. So it comes within the reach of a normal investor. And the great advantage of investing through LRS, there are many competing platforms available through which you can invest in international invest through LRS. You can go and invest in fund in USA. You can go on asset or direct stocks. But the challenges is that these platforms are unregulated. Many of these platforms are unregulated, point number one. And we have witnessed that some of these platforms have closed down in between, so investors are left to grapple with it.
So what you're suggesting is that, of course, through the LRS, what a lot of people are saying is that, okay, the domestic mutual fund industry is not able to provide you with the option available. So what a lot of people that are seeking to invest in global equity, and particularly the US or in China or elsewhere, what they're doing is they're setting up accounts with global brokers or global providers or platforms. And they're facilitating your transactions.
Yeah, so one is that these platforms that are not regulated, tightly regulated entity. Second, which is very important thing, is inheritance tax. Suppose you invest through these platforms and invest directly in international market, then if beyond a certain limit, 60,000 USD, I believe, if something happens to you and the money has to be inherited to your legal heir, at that time, up to 40% can go in form of inheritance tax.
Wow.
Many people who invested internationally was not aware about these.
Right.
But through this DSP fund, through Gift City fund, if you invest in through LRS route, then there's no inheritance tax applicable.
Sure.
So that way it is much better.
There are several questions that emerge about this scheme, okay? And the reason, viewers, why we're focusing on this scheme in particular is because it is the first of its kind. As Vijay just pointed out, the others have a much higher ceiling or threshold for you to get past, for you to invest in. So the first and foremost question is, it was launched earlier this month, and it has a significantly large new fund offer period, as I understand it, right? So how is it going to work? They're in the process of collecting money right now. When will they operationalize?
So they will start collecting money and then they will start investing immediately. It may just a gap of 10, 15, 20 days. So they will start investing. And you need to go to your bank and convert your INR into US dollar.
Sure.
So that responsibility today is with actual investor.
Sure.
Earlier, what used to happen, you give money in INR to the fund and the fund will convert into USD and then transfer. Today, you need to go and negotiate exchange rate with the banker.
And you need an account in Gift City as well.
No, you don't need an account in Gift City. You go to your normal bank.
Okay.
And banks are authorized dealer. You fill a form and you get the INR transfer. But before that, the better thing to do is to connect with your mutual fund distributor, your investment advisor, create a zero balance portfolio in Gift City.
Sure.
Using DSP Mutual Funds Service Center. Open that. Once that zero folio get created, then you transfer the money. But in this, you definitely need to take a help of your advisor.
Sure. Okay. And so therefore, the onus of transferring that dollar is on you, that conversion rate is on you.
That is like any LRS product.
Got it. So now this is done. Let's assume that you've done that and you've put that minimum amount. You've said that they will deploy it over a period of time. It'll start more or less now, right?
Yeah.
But how does that work and what are the contours of that fund? It's actively managed?
So the brilliant part is that it is not an index fund.
Sure.
And it is not a country specific fund. So it is an index agnostic, it is a geography agnostic, it is sector agnostic. They very clearly define how they're going to look at investing, and that's why I found it very interesting, because most of the global funds are looking at investing in high-tech company, innovation. This fund is looking at a little differently. It is looking at the company in which you and me are using the product of these companies like Puma or like Lilly or like Airbnb or these kind of organizations. So large, well-established player. So instead of big innovation, iteration is a one thing. Longevity over growth and resilience is the kind of thing they're looking at. So they're very well defined that they are looking at 5-6 big market, US, Canada, Europe,
South Korea,
Japan, South Korea, a little bit in China. And they are saying that they will look at investing in a company with minimum $30 billion market cap. That is number one. Number two, 5 to 7% revenue growth, earning growth. 2 to 4% shareholders yield, which is in the form of dividend and buyback. And if you see today in international market, there are some fantastic stocks available at very high dividend yield. For instance, look at Altria, is one of the tobacco manufacturing company in USA, available at less than 10 10 P multiple and close to 7% close to 7% dividend yield in USD.
But this fund is not going to invest in banks or tobacco. That's what I read.
No, I don't know about that. So they may look at. So you have a big gaming company part of this portfolio.
Yeah.
So one is that in my opinion, you're going to get a genuine diversification.
Sure.
Today, suppose if you ask anybody international investing, you would like to own NVIDIA, you would like to own Amazon, you would like to own this and that.
But there are so many you don't know about.
Exactly. So when you look at Amazon, and when you look at Louis Vuitton, or when you look at Brookfield Asset Manager, now for one Amazon, you need to search 100 companies to find one Amazon which made it big. But when you go to these well-established companies, even 50% strike rate makes you a good investor.
Yeah.
So people need to keep that thing in mind.
And 30 to 50 stocks is what they will
30
have.
to 50 stock, they are looking at investing. Sizing is 3 to 5% in individual stocks.
Yeah.
Buying companies at 30 to 40% discount to a fair value. And in the global market, beyond this big tech company, it is available. And if you look at very interestingly in US market, you have top 5 tech company, 35% of S&P 500. Top 5 companies are, if you look at tech, top 5 company in USA, they are 5 times bigger than Russell 2000.
Yeah.
It's an incredible number.
Yeah.
And if you look at return, these S&P 500 is available at 30 P multiple. If you look at other indices, they're available at 18 P multiple. And if you look at return, in India, small cap has delivered fabulous return compared to Nifty. But in US, it is absolutely the other way around.
Yeah.
The Russell 2000 has underperformed by 7% in last 10 years.
Yes.
So I believe there's opportunities beyond the big tech name, in my opinion.
Yeah, the size is something that you just can't wrap your head around. NVIDIA market capitalization would capture the market capitalization of a large part of our markets, right? All of it. NVIDIA
is 65% more. You put the entire Russell 2000, NVIDIA is 165% of that alone. Now the problem with these companies that if one quarter disappointing result,
then it's a significant wealth erosion.
You have challenges.
Yeah. Okay. So then a few more questions arise. Regulatorily, domestic mutual funds are governed by the Securities and Exchange Board of India. There are contours that are defined. For example, a flexi cap fund is open landscape, or a multi-cap fund is 25, 25, 25 in each large, mid and small. How does this work? Who's regulating it?
It is the GIFT City regulator, IFSCI, so International Financial Service Cap.
And how is that going to work?
So it is, they've taken by and large, exactly not regulated by SEBI, but it is, since it is offered by DSP Mutual Fund, so they will follow the best practices of Indian regulation. So they are not going to take advantage since it's listed in GIFT City, we can't do anything. Absolutely not at all. So by and large, it will be managed as per SEBI regulation. No, not strictly, but in the spirit they are going to follow as far as diversification is concerned, and all these things they'll take into consideration. And they are offering 2 share class, one direct and one normal. And expenses are 1.75% for a normal.
1.5, I thought direct.
25 basis, 1.5 is direct, but 175 is normal if you offer.
And I thought it was 2.5 for
no,
regular.
that has come down to 175. So they're not offering it 2.5%. So again, it is very competitive as far as pricing is concerned. And third is that it is governed by the GIFT City regulation. So it is a regulated product, it's not an unregulated product.
1.5 and 1.75 to invest in global equities at this juncture with our current context is not too expensive.
It's very good.
Yeah,
and you get the professional fund management team, you get a brand like DSP managing your money, an entity which is always err on the side of caution.
Do you think that more mutual fund houses will contemplate this?
Yes, I think they should, and they should come out with a differentiated product. Then it makes sense. Because if you're using GIFT City to feed into index fund, you can't charge 1.5%.
Okay.
And there are fantastic opportunities available in international market if you go beyond indices.
Now, so that's about the DSP option. I want to also talk about the investing in international equities as a concept. A lot of people tend to want to do this, and now through DSP as well, to manage currency risk. Directionally, over the last 25 years, and even before that, you've seen the decline of the Indian rupee, the depreciation of the Indian rupee. It's anywhere between 2 and 3% on an annual basis. Is that one of the best reasons to invest in international assets?
Interestingly, yes, and which currency will do which way, we don't know.
Yeah.
So today we are talking about Indian INR is holding is strong against USD, but not against Euro. Euro has appreciated much more. So there's definitely currency is one part. So second is that Indians send 11 lakh students every year, and that amount is pretty big. So if you look at education, inflation has been 4%, currency depreciation actually has been 3 to 4%. So if you want to send your kids abroad for higher education, 8% is a minimum threshold you should look at. This fund, in my opinion, look at 10 to 12% kind of dollar return in 3 to 5 year period. So if you want to take international exposure, if you want to protect your money against the international currency as well as education costs, then this is one of the product you could look at examining.
Okay, couple more questions. 4 lakh plus rupees, not a small amount. Of course, if somebody's been investing for some time, they will have a sizable corpus. But if you're starting out, what is the kind of exposure that you should be willing to take as a part of your entire portfolio?
So in my opinion, one should look at investing at least 10% into international market because we consume the product of these companies.
Sure.
So today, if you look at consumption pattern, we consume, India does consume, we live in a global village. So I think 10% is a good idea. And 4,30,000 is not a big amount because look at iPhone is 1,50,000 and how many people are buying iPhone?
Yeah, that's a strong argument to make.
Yes.
But having said that, overexposure is something to also avoid. So 10% is what you're saying is an ideal. How much is too much?
I think 10%, in my opinion,
is correct.
You can, in this market condition, you can take at 20% as well because Indian markets are very funny. They don't look at Nifty P multiple, which is 2022. But if you look at average P multiple of 750 companies in India, the average P multiple is 40.
Yes.
At 2026 earning.
Yeah.
So we are not cheap.
No, you're seeing practically every day, Vijay, the margin for error for a company posting numbers, results, is just wafer thin. If you miss even on one parameter, you're going to get trounced in the market, and that is evident. So anyway, the point is well made. Look for diversification. Hopefully more mutual fund houses will come out and give this option, and hopefully that ticket size also comes down further.
Exactly. So and you also need to keep in mind that what is cheap today? Debt is offering very low because after the interest rate has come down, gold and silvers are at hitting the high every day because of dollar. Real estates are not cheap. Equity markets are not cheap. Indian equity markets are not cheap. I don't think Indian equity markets are going to fall any which way big time because it is today become front line on assets and we have huge inflow coming from various sources. So I don't think we see big correction, but from here onward, at least for 2-3 years, to make double-digit return will be a toss in the air.
Yeah, all right. On that note, Vijay, thanks so much as always for taking the time.
My pleasure.